Hello everyone, and welcome to our quarterly market update. I'm Brent Kehrwecker, and joining me as always is Carey. We're here to review the third quarter performance of 2024, give you an overview of the stock and bond markets, discuss the upcoming election impact on the economy, and talk about what we see happening for the remainder of the year.
Let's start with the numbers. Stocks this year have had their best first three quarters of the 21st century. The S&P 500 delivered a year-to-date return of 21%, with a third quarter gain of 5.5%. The Nasdaq, driven by continued tech sector strength, has seen impressive year-to-date returns of 21%, gaining 2.3% in the third quarter. Meanwhile, the Dow, more sensitive to traditional industries, posted a more modest year-to-date return of 12.3% and a third quarter gain of 8.2%. Finally, the bond market, represented by Aggregate Bond Index, showed a year-to-date return of 4.6% and 5.3% for the third quarter. Gold has been the big surprise this year, up 24% year-to-date.
With the 2024 election just around the corner, many of our clients are asking how the political landscape might affect their investments. Historically, election years do bring heightened volatility as markets react to potential policy changes. It's important to remember, however, that market fundamentals, such as earnings, employment, and interest rates, ultimately drive long-term performance, regardless of short-term election jitters.
Looking ahead to the remainder of the year, we expect continued volatility as we approach Election Day. The fourth quarter is historically a strong one for stocks, and analysts, despite noting the likelihood of the expected elevated volatility, are broadly optimistic about the outlook. Barring any major geopolitical or economic shocks, we're cautiously optimistic about the potential for modest gains in the fourth quarter.
One of the key stories for the third quarter was the Federal Reserve's decision to cut interest rates in September, marking a shift in monetary policy. This move came in response to signs of slowing inflation and an aim to support economic growth. Lower rates tend to provide a boost to the stock market, making borrowing cheaper for companies and consumers. However, it also impacts fixed income investments like bonds, which we've already seen reflected in the bond market's more modest returns. We think it is possible the Fed potentially could cut rates even further before year-end.
So, what does this mean for your portfolio? The key is to stay diversified, avoid reacting impulsively to short-term market events, whether it's the election-related volatility or shifts in Fed policy. Our job is to help you navigate these uncertain times with a long-term, goal-oriented approach.
As always, if you have any questions or concerns, or if you'd like to discuss how these market updates might impact your financial plan, please don't hesitate to reach out. We're here to help you stay informed and make the best decisions for your future. Thank you for trusting us with your financial journey. And remember, please hit the subscribe and like buttons to receive future updates.